This is a real quick keynote that I put together for my in-class students on the chapters 1 through 3 of Man versus Markets. And I thought it would be fair to make a quick video. I'm kind of learning how to use my iPad to do things like this. It's really quick, simple, and handy. So I'm going to kind of walk you through a real short lesson on Man versus Market. The first really what Man versus Markets is about is investment, um, different types of investment, and how it's important and how all the investments work. And in the very first chapter, it talks about investors being the lifeblood of business, and that businesses require a lot of cash. And the reason they require all this cash is they got a lot of bills to pay. Um, And really, what we mean by that is they've got to pay labor, they've got to buy supplies, they've got to buy inputs, and the big one is they've got to purchase capital. And remember that in economics, capital isn't money itself. Capital is the machines and the equipment that we use to produce other goods and services. And business requires a lot of capital, right? One of the things that, one of the problems with most financial books, and this book included, is financial world counts money as capital. In economics, we actually don't count money as capital. Money itself doesn't produce anything or provide us with anything. But money is the source of being able to purchase capital. So that's why it's called the capital market. Businesses are actually out there trying to buy equipment, to build things, to create things. And in order to do so, they're going to need money. And so that's why we use this book. For right now, we're just going to use the first 3 chapters. As we move along in the semester, there's a couple times that I would like to introduce some of the other ideas from the book later on. One of the main topics of the first couple chapters is the difference between stocks and loans. And so we're going to talk first about stocks. Stocks are simply shares or part ownership in something. Okay, it's as simple as that. It doesn't have to be a business. You can own shares on a car. The example in the book, the 3 little pigs and the brick house, they all decide to move into it to keep themselves safe from the big bad wolf. The brother that built the brick house says, "Well, you can live here, but now you're going to be free, and I'm not going to charge you rent. You're going to be part owner, so you're going to buy a share of the house." I told my in-class students my dad's into quarter horse racing, and he owns about 4 or 5 of them by himself, but on another 4 or 5 horses, he's actually in syndicates. So him and several other owners own the horse together. One of which he won a bunch of money while they were racing him. He's now a stud, runs on the track, or excuse me, he does not run on the track. They use him to breed mares for new racing colts. So in a sense, he's now become capital. And there's 10 people that own this horse together, and they all have an equal share in the horse. And so really, what that share that Dad has, it's 1/10 of the horse. You can't obviously part the horse up into 10 pieces, so he's entitled to 10% of the profits that are generated by that horse. That's really what shares look at. That's one of the problems with shares in houses and in businesses too, is it's really hard to part them up and sell them off in pieces. And so we expect that the business will continue to earn money, and then we'll receive our um, portion of the profits. Publicly traded companies, it talks a little bit about the New York Stock Exchange and the NASDAQ. Um, they get traded in an open exchange. Exchanges tend to be, the open public exchanges, tend to be transparent and liquid. And what we mean by transparent is we're always able to see what someone else paid for a stock. So I always know what the last person that bought or sold that stock paid for it. And that becomes important for understanding price. We always want to know what someone else paid for things. So they're very transparent, and then when they are transparent, they tend to be more liquid. We tend to attract more buyers and sellers, and the more buyers and sellers we have in a market, the faster we're able to buy a product or sell it, or the faster it moves. Liquid markets are really good. illiquid markets become really tough. My main specialty is ag economics and really commodity marketing. And a few years ago, me and a friend decided to do a little speculating in the rice market in the United States. We had a plan. We thought we were gonna make a bunch of money. Um, One of the things that and we knew this, we knew better, but we neglected to think about when we put our plan into motion was the rice market is fairly illiquid. There's not a lot of people in the United States trading rice, and so if you get put on the wrong side of the market and it moves against you, and you start losing money, it becomes really difficult to find someone to buy that share or that contract from you. And so we end up losing quite a bit of money because we didn't use our heads and remember the fact that liquidity in markets is really important. Um, I always talk about examples of publicly traded companies and the difference between a private company and a public. For years, Facebook was a private company. It was developed by young kids. They obviously had investors. If you've watched The Social Network, it kind of parses out the development of the product and the first initial investors and all that kind of stuff. That's a company that uses a lot of cash. They've got a lot of equipment. They've got a lot of research. They've got a lot of expensive people working there. So they need a lot of capital. They need a lot of cash coming in to help purchase all that capital. So Zuckerberg sought out several different investors to help him get the ball rolling, but they were private investors. It didn't go through a public exchange, and basically it was a private deal. He offered to sell shares of the business to other people, and they would buy them for the price that they determined was reasonable. A few years ago, Facebook decided to go public. Basically, what that means is they part all of their business up into however many shares they feel. As the business owner, you get to determine the number of shares that you're going to part it up into. So if it's $1 billion business and you want the shares to be worth $1 a piece, you can sell 1 billion shares. If you wanted to be worth $100 a piece, you'd sell 1 million shares. Okay, and that's sort of how the system works, really quick and easy. It talks a little bit in the Man versus Markets about dividend payments. That's not a must. That's up to the company's discretion. Facebook does not pay a dividend. One of the reasons is Facebook is a growing company. They're going to take their profits and plow them back into the business. Facebook is going to use profits in order to buy new businesses, create new businesses, so on and so forth. A few years ago, the big news was Facebook went and bought Instagram. The reason we might buy Facebook, though, is because if it's selling at $40 a share, I might buy it today in hopes that next year or the year after it's selling at $60 a share. When I was in high school, you could have bought a share of Apple stock for approximately $10 a share. And as of last year, March, that same share would have been trading somewhere in the neighborhood of $700. So, had a person bought 1,000 shares, you would have spent $10,000 to buy those 1,000 shares. Trying to think, that'd been about 16, 17 years ago. Had you held on to them until last year in March, those shares would have been worth $700,000. So, $600 and some $1,000 worth of profit that you could have earned. And so that's what a company like Facebook is depending on, is people are going to buy their stock because they see room for that company to grow and become more valuable. A company like Coca-Cola or ExxonMobil probably not going to play, or probably will pay a dividend, excuse me. The reason they're going to pay the dividend, sorry about that, the reason they're going to pay a dividend is because of the fact that they don't have a lot of room for growth. Their stock price probably isn't going to fluctuate too much. It might drop a little on some news. It might increase a little on some news, but it's not going to double in price or skyrocket as far as increasing. And because of that, in order to keep people interested in investing, they have to pay a dividend to keep people interested in buying their stock. Right? The book talks about a stock split, interesting one in 2014 was actually in April of last year. Apple decided to split their stock. They did a 7-to-1 split. So at the time, Apple stock was trading somewhere around $700. After the split, basically what it did is if you owned one share, your one share became 7, and they're now all worth $100. So total value of your ownership stake stayed the same. It's just each share became cheaper. One of the reasons they do that is it becomes more competitive, and it's, your potential purchaser of stock just increased by the fact that your stock price is only $100 per share versus 700, and that, we saw that increase then immediately after a big run on Apple stock because new people could now purchase it. And then the last one, share delusion. They talk a little bit about that. That's disliked by the market typically, and that's because it makes your shares worth less. If your company has 10,000 shares and you magically create 10,000 more and throw them onto the market and sell them, you just diluted the price of the shares that shareholders already had. Tends to tick them off. A couple examples: the New York Stock Exchange and the NASDAQ are example exchanges. Leverage, talks a lot about leverage. Unfettered debt. What I mean by that is just piling up debt, borrowing more and more money. It can cause problems. A lot of times people are afraid of debt. I hear a lot of people say how much they hate debt. They don't want to go into debt. They don't like to borrow money. Debt's not always a negative. All right? Debt's been around a long time. And then the book goes on to kind of show a few ways that debt can be racked up. Oops. Wrong button. One of the ways we can rack up debt is through the bond market. In a bond market, the investor buys a promissory note from the bond issuer, right? That's basically a promise to repay. Okay, so if I've got a company and I need money, I basically write up on a piece of paper, hey, I want to borrow $1,000 from you. That would be the face value. I'm going to pay you $100 a year for the use of your money, so that's a 10% interest rate, and I'm going to keep this $1,000 for 10 years. So basically, each year you're going to get $100, the coupon payment, and at the end of 10 years, I'm going to give you your original $1,000 back. So as long as I put down the face value, the term, so the length of the loan, or not the loan, excuse me, the bond, and the coupon value on that note or that piece of paper, I've just issued a bond that's worth something. Once you get it, say you step out and you buy that bond from me in the bond market, and now you need to free up cash, you can go and trade those bonds. There is a bond market where people trade bonds because they need to free up cash. Businesses sometimes, when they have a lot of cash, will go out and they'll buy bonds on other companies, and then when they need to free up cash, they'll take those investments and they'll sell them off to someone else. Sometimes when they sell them, the coupon could be higher or it could be lower. Just depends on the terms of the agreement. The loan market, I put on there paper, note, obligation, liability. They all mean the same thing. You might have noticed when you're reading through it that we use a lot of different terms for the same thing. I used to teach a class on finance, and students always hated the fact that I would institute different terms for the same idea. And my reply is always, get used to it. That's the way the world works, and I didn't create the rules. I just teach it. So, loans are generally produced through banks and credit unions. They can also be personal. You can borrow money from a family member or a friend. You can have the terms of the loans written up on a term sheet. You can take that term sheet to a courthouse and place a lien on it, file it, and it would be a legal document that allows you to be compensated if there's security or anything like that against the loan. The term sheet, though, needs to contain principal, so the amount you borrowed, the length of the loan, what the value of it will be, the interest rate, and then what the payment schedule or plan is. It talks a little bit in the book about lending and how it was once frowned upon. Just interesting history about lending. Jewish law actually required lenders to forgive loans in the seventh year. The seventh the number 7 was somewhat important in biblical times. It was because the seventh day you're supposed to rest. It was a Sabbath day. And basically they decided, all right, lending's bad. It was called usury at the time, and Jewish law said, all right, if you're going to make loans, you have to forgive the loans in the seventh year. Well, as we've already discussed, humans will always break those incentive schemes. You know, the incentive scheme there on forgiving the loan in the seventh year was that you would be honest and treat your borrowers better. It would be kind of a showing of altruism. But even though that's what we were trying to incentivize, people figured out a way to break it. And basically, they just started writing notes up for 6 years. So, yeah, I'll loan you the money. I'm just not going to loan it to you the seventh year. You need to have it all paid back in the seventh year, or else I won't loan you the money. So, it wasn't really until the 15 and 1600s that the practice of lending became a widely accepted practice, and I always find that funny because that's about the time the Industrial Revolution really got its foothold. Good chance that had something to do with it. The last slide is just capital structure, and this is basically chapter 3. Chapter 3 is really short, just showing you the hierarchy of who gets paid, or cash flows of the company. Your senior secured debt is going to be at the top. So if I go out to JP Morgan Chase and borrow money on a secured debt, that's going to be first in line for repayment. Any second liens, so some other company that maybe has a second lien against a company that borrowed money from, they would be next in line. Mezzanine debt, that's really going to be some of your bond market, that type of stuff. And then the equity stakes, the shareholders, they come in the bottom. And that's why in bankruptcies, shareholders generally don't get anything. They're the bottom of the list, and typically if a company goes through bankruptcy, they obviously have monetary problems. They're not going to be able to pay everyone back, and that's the reason they're in bankruptcy court in the first place. If you're a common shareholder, you can probably expect not to get much in return for your business. So that's really the nuts and bolts of the capital structure. If you got any questions, make sure you email me or call, and we'll try to get them answered. Thanks.